Welcome to Fear and Greed Summer Investing Series, brought to you by Vanta, specialists in compliance-led growth. I'm Sean Aylmer. The travel sector has bounced back well from the pummelling it took during the pandemic. Today, we're getting some tips on what to look for when investing in travel and leisure. As always, this is general information only, and you should seek independent advice before making investment decisions. Brian Hand is the Director of Equities Research Australia New Zealand at Morningstar. Brian, welcome back to Fear and Greed.
Good to see you, Sean.
The travel and tourism sector had a great recovery post-COVID, but where are we now as we enter 2025 for that sector?
Yeah, Sean, I think we're entering that stage where the market is undecided and on a knife edge between number one, yes, we still got that pre-COVID levels to get up to, but number two, we're having some pressures on cost of living, on mortgage, and all of those economic concerns. And therefore, should I be spending money on travel rather than paying off my mortgage? So I think we're on a knife edge in terms of what the outlook could be in the near term.
What surprises me about travel companies, towards the end of last year, there are certain stocks, Qantas being an obvious one, doing really well, share price high or close to highs. Then some of the other ones, some of the more corporate ones, didn't seem to be doing so well. What are some of those stocks that you like and some you don't like in the sector?
One stock that we do like is Flight Centre. Now, we like it because a lot of people equate them to these branches everywhere, and they'll be susceptible to technological disintermediation. But we think one aspect of Flight Centre that people overlook is the fact that they are very overexposed to the older demographics, the people who are cash rich, asset rich, and they're not really susceptible to these cost of living things and interest rates rises. In fact, they like it when interest rates rise because that's good for their retirement earnings and deposits. So I don't think people are appreciating how much Flight Centre is leveraged to that demographic, and that gives them a certain element of resilience to their earnings. And then, Sean, you mentioned that some of these corporate exposed businesses, travel, they're not doing well, but if they do recover, Flight Centre is also leveraged to that because half of the business, people don't know this, but half of the business is leveraged to that corporate travel spending.
What about Qantas?
I would be extremely careful on Qantas at these levels, Sean. I think 1 or 2 years later, people will look back at this and say, what was I thinking paying $8 to $9 per share for
Yep.
Qantas when I know that capital expenditure is going to go up? And we know that there will be more capacity coming into this market. And so one of the things, Sean, that people need to be mindful of investing in leisure stocks and travel stocks is that you don't want to invest in a travel stock ahead of any capital expenditure bump that's coming on. Because when conditions turn, you might have a good balance sheet right now. But when the conditions turn, that good balance sheet can turn to jello very quickly if you have a big capital expenditure profile coming on.
And at Qantas, we know they're going to have to spend a lot of money on planes over the next decade or so. Is that kind of the basis of that?
I think so, Sean. And I read Joe Aston's book, and if it was up to him, they'll probably have to spend billions. So there does seem to be a little bit of underinvestment that's been going on in Qantas, and sooner or later, I think that will catch up.
Okay. What about other leisure stocks, not necessarily specifically travel? What do you like or dislike?
Other leisure stock, one that people are probably ignoring at the moment is a travel company called Web Travel Group.
Oh,
They
yeah.
used to be Webjet. Now they spun off Webjet, the good little website that you and I use to book travel. Now they are purely 100% digital B2B hotel beds accommodation provider. So it's got a really big growth runway in terms of it participates in a global space that is huge, and it is only a very minuscule player in that growing market. So the runway is significant. It's got no debt at all, plenty cash, and right now it's suffering but from a bit of a sentiment slump because 2 days after it emerged, it made a big profit warning. But I think if you can look over that, I do believe that there is a lot of value in that stock.
Do you think generally as a sector, travel and tourism and leisure is a good area to be given the economic cycle?
I'm not sure about whether it's a good area to be, but one thing I can be sure of, Sean, is that whenever you hear really unfortunate, shocking news like terrorist attacks, plane crashing, economic uncertainty, even a pandemic, I do believe that your listeners should look at leisure sector as one of the first sectors to look at, because whether you want to use euphemism like, buying straw hats in winter or buying it when there's blood on the street, this is one sector that really applies. You want to buy it when everybody is completely averse to it because of all the risks. Because once you pick a company that's got a good balance sheet, I do believe that things will always turn around because people will always travel and have a good time.
Brian, thanks for your time today.
Thank you, Sean.
That was Brian Hand, Director of Equities Research, Australia New Zealand at Morningstar. Remember to get your own independent advice before making decisions. This is Fear and Greed Summer Investing Series brought to you by Vanta. Vanta automates compliance for frameworks like ISO 27001, SOC 2, CPS 234 and Essential 8, saving time and money while building trust. Join over 8,000 companies like Atlassian, Dovetail and FireAnt managing real-time risk. Get $1,000 off at vanta.com/fear and greed. I'm Sean Aylmer. Enjoy your day.